Okay, well, we're here with another segment of Arizona Mortgage News Insider Update. We're here with our Arizona expert, Mike Goblet of United Mortgage and Financial Group. Good to see you, Mike. How's it going?
Good, Matt. How are you? Good to see you again.
Thank you. You know, it's Friday. All things are good on Friday. And you have an interesting topic that you have a little learning lesson for us. So it sounds like the inquiry today is learn when choosing a higher interest rate, how this can give you a lower monthly payment, APR, and save you what I think most people are going to be excited about, thousands of dollars.
Yeah, it is an interesting concept and also very much a reality. There is a time when choosing a higher interest rate can do those things, including giving you a lower APR. And that is when you have less than 20% equity or less than 20% to put down on a purchase. Because when you do that, you generally or traditionally have what is called PMI or MI, private mortgage insurance. Now, what private mortgage insurance is actually insurance provided by a neutral third party for the lender in case the consumer were to default on that loan. PMI or the mortgage insurance covers that portion of the money that isn't 20%, okay? Or, you know, if you put 5% down, they cover that 15% in there for the lender in case you were to default. So the lender stays whole at 20%.
That makes a lot of sense.
So it's money that you pay monthly that does nothing more than provide insurance for the lender. And a way to avoid that is to use what is called LPMI, lender-paid mortgage insurance. So it's a little bit of a shell game, but not really, because this is an avenue that can potentially save you thousands of dollars over the course of the years and actually provide you a lower monthly payment, okay? So here's how it works. So let me give you an example. Let's do a home purchase, and let's make it a $200,000 home for ease. And now what we're going to do is put 5% down or $10,000 so you have a loan amount of $190,000. Pretty simple so far.
Pretty simple.
Now, let's say with a mortgage rate, let's say you want to do a no closing cost loan. So that rate today would be 4.25%. I could get enough lender rebate to cover all of the closing costs. Well, your principal and interest payment, if you were to do a conventional loan with 5% down at 4.25% or 95% loan to value, would have a principal and interest payment of $935, but you would also have $85 a month in mortgage insurance that you would have to pay. So your total payment would be $1,020. Pretty simple.
Very much.
Now, if you choose lender-paid MI, and really what you end up doing is choosing a higher rate, so the lender gets their money on a monthly basis, okay? But now, to do a no closing cost loan today, the rate on that same loan would be about 4.5%, so you're paying a quarter higher. But here's what happens, okay? First of all, your APR on the lender paid is 4.565 at the 4.5%. What I forgot to mention on the 4.25%, because of the MI, your APR is 5.057. So it's a half a point higher in terms of the APR. Now, on the 4.5% rate, your principal and interest payment is $962, and there is no MI. So that's your whole payment, or it's $58 a month less than the conventional loan at 4.25% with the MI. So you're saving $696 a month, okay? But now you say, yeah, but I can eventually drop the MI. And the answer is, yes, you can, and then you can start saving. But let's look at what that really means. First of all, the $696, if you were to hold it for 5 years, which is kind of a normal figure that you'd figure you might be able to drop MI if everything goes well with appreciation and what you're paying down. Well, if you save that $58 a month for the 5 years, you have now saved $3,480 during those years, those 5 years. So you've saved, thousands of dollars, $3,500. So now what happens at the end of the 5 years when you say, yeah, but now I can get out of MI? Okay, you're right, but your payment drops $27, okay, because that was your original principal and interest payment, the $935 versus the other. So you're saving $27 per month in the new lower rate. So if you divide the $3,500 by $27 a month, it would take you another 129 months of savings to equal the rebate you didn't save. So essentially, it takes you 15 years just to break even if you do the calculated math on that.
Plus, you're getting that money up front, so the dollar cost average is in your favor.
Exactly, exactly. It's really a good scenario once you really understand the details, and don't be afraid of the higher rate, because the reality is, because you don't have MI insurance, it actually saves you a lot of money.
You're right, that is kind of a shell game, but it makes all sense when you spell it out so eloquently like you did.
So I think it's a great option for the customers. So and I'm happy to provide anybody that's interested in learning about the LPMI program, Lender Paid MI program, happy to discuss it with them in their scenario.
Excellent. Well, what's the best way to get in touch with you, Mike?
Well, you can reach me at the office number, which is 480-503-3533. You can email me at mike.goblet at our company initials, umfginc.com. Mike.goblet at umfginc.com, or call me on my cell phone at 480-220-2329.
Excellent. Well, thanks again for enlightening us. That's an interesting program, certainly one to take a look at. Seems like makes a lot of sense.
It's all about knowledge and what works for you and what's the best program. So it really goes to the fact of the lowest rate isn't always the best program, and there's a lot of reasons why.
And you need a knowledgeable person like yourself to sort things out for those that are a little bit confused, and easy to get confused in this program.
Absolutely. So.
Well, great. Well, thanks, Mike. Look forward to the next segment.
Me too, Matt. You have a good weekend.
You too. Bye-bye.
Bye now.